What's up, guys? I'm Nobody Special. And as we continue to watch the China Evergrande collapse and the fall of the Chinese housing market, there's a lot of talking heads are worried about how much real estate makes up of China's GDP and whether or not it'll be contained and what the effect could be on Chinese banks and by extension American banks. But there's one very important factor that's not getting a lot of attention right now, and that is the Chinese consumer and a phenomenon that's known as the wealth effect. And that could spell big trouble for the Chinese economy and by extension a lot of companies in the S&P 500 next year. Are you ready? Hit it. Thank you for joining me. I'm Jack Gamble and I'm Nobody Special. And the Chinese consumer is not getting enough attention in this real estate collapse scenario that's playing out in China right now. Now, there's a lot of talk about how much real estate and construction makes up of China's GDP, but the Chinese consumer is a much bigger percentage of China's GDP. And looking back at the United States and the global financial crisis, we can see that when there's a large decline in housing prices, consumer spending slows down big time. And that could cause big problems for the Chinese economy and by extension United States companies. Now, before we get into the numbers, folks, I have to ask, could you please like this video, subscribe to my channel? Don't forget that notification bell. Really helps me out and it helps me to keep these videos coming your way. And with that, we are going to shrink my big fat melon of a head and get into the topic of the day, and that is the wealth effect. And the wealth effect is basically how people feel wealthier when their assets are going up in value, and therefore they're likely to go out and spend more money, whether they actually sell those assets or not. Now, there is some debate about the wealth effect and whether or not it is causation or just correlation, but there's one study in particular that we're going to look at that shows a very strong link between the two. Now, this is an Investopedia talking about the wealth effect, and the wealth effect is a behavioral economic theory suggesting that people spend more as the value of their assets rise. The idea is that consumers feel more financially secure and confident about their wealth when their homes or investment portfolios increase in value. They're made to feel richer even if their income and fixed costs are the same as before. So the key takeaway here is that you feel richer even though you haven't sold your home or even though you haven't sold your stocks. Just the fact that watching those assets go up in price makes you feel richer, you're more likely to spend. Now, there has been some debate over the years on this topic, so I went looking into some of the data behind it, and I came across this fantastic paper called Wealth Effects Revisited that was done for the National Bureau of Economic Research, and this is by Carl Case, John Quigley, and Robert Schiller. And if some of these names sound familiar to you, it's because they should, because two of these guys are behind the famous Case-Shiller Home Price Index that's used to gauge housing values. Now, I'll put a link to this study down in the description if you want to check it out for yourself. It's 34 pages long, and it can be a bit of a dull read, but we're going to touch on some of the important aspects right here and now. So this paper looked at a couple of things. It looked at the wealth effect as it pertains to both housing and financial wealth versus its effect on consumer spending. Now, housing obviously is home prices going up in value or down in value and the effect on consumer spending. And then the financial wealth was looking at the performance of stocks and bonds and that effect on consumer spending. Now, we're going to fast forward to some of the conclusions here, save you 34 pages of reading because that's what you have me for. And I just want to read some of the conclusions here. The authors say, we find at best weak evidence of a link between stock market wealth and consumption. In contrast, we do find strong evidence that variations in housing market wealth have important effects upon consumption. This evidence arises consistently using 30 one-year panels of U.S. states, and this finding is robust to differences in model specification. So that is a mouthful. So in a nutshell, they find that big swings in the stock market, up or down, do not necessarily have any impact on consumer spending. However, they found that big swings up and down in housing prices absolutely does have a big impact on consumer spending. I just want to get you some of these numbers down here. As for the magnitude of the effects, consider a few of the most recent changes in housing wealth. Now, this paper was written in 2012, so when you hear recent, keep in mind the time frame. The decline in housing wealth from 2005 to 2009 was roughly 30%. This is talking about U.S. housing wealth after the GFC. That figure implies that a decline of 35% in housing wealth would lower consumer spending by 3.5%. Consumption is about $10 trillion, and that in turn implies a decline in consumption of about $350 billion annually. To put those figures in context, consider the effects of the decline in housing production from 2.3 million units to 600,000 at $150,000 each. This implies reduced spending on residential capital of about $255 billion. Either has a large impact on the economy. Together, they have a very large impact on the economy. So what they're talking about here is that even though it was a 3.5% decline in consumer spending, which may not seem like a big deal to you, when you consider the size of the U.S. consumer market during that time frame, $10 trillion, that was $350 billion a year in less consumer spending in the U.S. economy. Contrast that with $255 billion less spending in home construction after the global financial crisis, and you can see that the wealth effect on consumer spending was even bigger than the slowdown in home construction. And combined, you're looking at more than a $500 billion decline in GDP. Now, that was in the U.S. in the aftermath of the global financial crisis. Now, elsewhere in the report, they looked at increases in consumer spending from 2001 to 2005, where home values in the United States increased by almost 90% on average. There was almost $10 trillion in new home value wealth in the United States during that period. That was the housing bubble. Well, during that time, household consumer spending increased by 4.3%. So you see, when home prices are increasing, consumer spending increases. When home prices decrease, consumer spending decreases. People feel wealthier when their home goes up in value. Now, this report also looked at the effect of big swings in stock market prices, and they did not find any strong correlation between stock markets and consumer spending, or bonds and consumer spending. But they definitely found a big correlation between home prices and consumer spending. Now, there's one chart in particular that I want to focus in on in this, because this gives us some insight into what we could expect if we see the same effect, the wealth effect, hit Chinese consumer spending as a result of this Evergrande collapse. And this is on page 8 of the report, if you feel so inclined. Now, what this chart is showing is the year and the total residential real estate value versus the nominal GDP in trillions of dollars. So it's showing the real estate value as a multiple of GDP. Now, you can see here at the peak in 2005, the total real estate value in the U.S. peaked at $22 trillion. And nominal GDP at that point was $12.6 trillion, which meant that at the peak of the housing bubble, total household real estate wealth in the United States was 1.74 times GDP. We had 22 trillion in household wealth. We had 12.6 trillion in nominal GDP. Now let's contrast that with some of the Chinese numbers. Right now, the estimated value of the Chinese residential real estate market is $60 trillion. So nearly triple this 2005 United States housing bubble number. 60 trillion versus 22 trillion in the US. And China's nominal GDP is estimated for 2021 to come in at $16.86 trillion. Just slightly larger than the GDP in the United States at the peak of the housing bubble. So triple the real estate wealth, only a slightly larger GDP, which means as a multiple, the Chinese housing market is over 3.5 times the size of the total Chinese GDP. Now consider a few other statistics. That you have 90% home ownership in China. All right? Way more Chinese own their home as a percentage of the population than did in the United States at the peak of the housing bubble, which means the wealth effect should be even more potent in China. And then consider that the average Chinese investor has most of his wealth in his home, because Chinese investors are not as heavily invested in the stock or the bond markets as they are here in the United States. Again, the wealth effect on the Chinese consumer should be even more potent because of this phenomenon. Now, there's been an awful lot of talk in the press about how the real estate sector represents 24% of Chinese GDP and how the slowdown in construction could cause a recession in China because of that 24% GDP number. But remember from this wealth effect study that the impact on consumer spending in the United States after the GFC was even bigger than the effect on the construction industry. So let's look at the consumer spending in China. Well, right now, the Chinese consumer represents 54% of Chinese GDP, more than double the amount of real estate construction. Now, let's assume we have the exact same reaction in China that we had to the global financial crisis in the US, and we see about a 3.5% reduction in consumer spending in China. That would be a loss of about $318 billion worth of total GDP in China, or roughly a 2% decline in GDP just from consumer spending going down. This says nothing about the collapse in the real estate industry. Now consider the fact that the residential real estate market is triple the size of the residential real estate market in the United States at the height of the GFC, and that the average Chinese citizen has more of his wealth invested in real estate than the average American did in the global financial crisis, and that way more Chinese citizens are in the real estate market because home ownership is so high in China. When you consider all those factors, then it's entirely plausible that the wealth effect and the reduction it causes in consumer spending in China following this housing collapse could be orders of magnitude larger than the decline in consumer spending in the United States following the global financial crisis. So while everybody is talking about these developers going under and how important real estate construction is to the Chinese economy, they're forgetting the fact that the Chinese economy has very slowly shifted from industrial to consumer driven. More than half of China's GDP now is consumer spending, which is at risk because of the wealth effect. Now, you're also hearing a lot in the press about contagion risk and will this situation be contained to China? My response to that is no way. Because if you look at the S&P 500 and where their earnings come from, first of all, 79 of the 500 companies in the S&P 500 get at least 5% of their revenue from China. Now, that's heaviest in areas like casinos and hotels, which they're going to be wiped out by these crackdowns on gambling in China. But there's also companies like chip makers that get 40, 50, even 60% of their earnings from Chinese consumer spending. Those companies could take a huge hit to earnings. Don't forget Apple, the biggest company in the world. Do you think if people are watching their investment go up in smoke, they're going to be first in line to buy a new iPhone? Apple gets almost 20% of its revenue from sales in China right now. So a big decline in Apple sales, what will that do to the S&P? So there is just no way that this situation is going to be contained to China. There's going to be global implications for American companies, for European companies, for banks, for everybody. So long story short, there is significant data to suggest that a big decline in home prices does result in a major decline in consumer spending. And considering some of the dynamics of the Chinese housing market and the differences in how this bubble is even bigger than the bubble in the US during the GFC, it's reasonable to theorize that the wealth effect will hit Chinese consumers even harder than it hit American consumers in the GFC. And that is very bad news for the Chinese economy and by extension for American companies that do a lot of business in China. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget to give me a big thumbs up, subscribe to my channel, hit that notification bell. It really helps me out, helps me to keep these videos coming your way, and I'd be forever in your debt. Don't forget, tomorrow is my weekly live stream for Power Hour, so come send me your questions, and I will respond to those live on the air. And until next time, live small and dream big.